Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Let's go back out to the West Coast, to San Francisco. SpaceX discusses spinning off Starlink via IPO as soon as 2024. I don't know what's going on there, but Ed Ludlow does. He's the host of Bloomberg Technology. He's out there somewhere in California. I don't know where. Sometimes he's in the desert for these rocket launches.
Dude, as soon as late 2024, that's not soon at all.
Exactly. I'm not putting that in my
as far away as late 2024. That's like 100 years from now.
Exactly. Ed, what's happening with our good friends at SpaceX?
Yeah, all good points. Look, sources tell us that this IPO, which is a spin-off as Starlink as a separate unit, could happen towards the end of 2024. The end of 2024, we have an election, so bear that in mind. And if not 2024, 2025. And Matt, you're completely right. That is distant, but this is highly anticipated, right? You know, given the recent news flow, Musk confirming that Starlink, which is SpaceX's satellite constellation-based internet service, has reached cash flow break even. That is what he has said pretty consistently over the years would be the trigger to work towards a listing, spinning off through a listing. And what my colleagues and I are reporting is that even though that is far away, they're taking really material steps towards doing that. So for example, one source told me that they're already shifting Starlink's assets, its business assets, its people, to a new wholly owned subsidiary to prepare it to be a sort of standalone unit ahead of an IPO.
The amazing thing to me, you write this in your story with Gillian Tan and a couple of other Bloomberg News reporters. They're expecting Starlink to generate $10 billion in revenue next year, which eclipses that of the rocket launch business at SpaceX. So it's essentially it's essentially their core business at SpaceX, right? At least judged by sales.
Exactly right. It's essentially their core business. So what we reported was that revenue's due to jump significantly next year to around $15 billion. This year overall, it will be about $9 billion with a pretty even split between launch and Starlink. But next year, Starlink will be the vast majority, more than $10 billion. Guys, I just want to say, for sheer transparency with the audience, that as soon as we published the story, Elon Musk responded to a user on X, the platform formerly known as Twitter, who had posted a screen grab of the story, an image of it, and Musk's response was one single word, which was false. So on the face of it, Musk is denying the accuracy of our report. But I would also tell our audience this is not the first time Musk has replied or posted on X about something I've reported saying it's false, that in the end is proved completely true by regulatory or legal filings or otherwise.
I mean, this sounds like a really cool business, admirable business, kind of connecting parts of the world that, can't get, I guess, internet connectivity besides it. Are there competitors to Starlink out there?
Well, the legacy space-based internet companies like Viasat, for example, but they've just not been able to make this a business in the way or the speed that Starlink has. If you remember, Paul, when I was in New York last week, we talked about Starlink's revenues. And the reason that it's worth discussing and reporting the stepping stones towards an IPO is that this is the mainstay of SpaceX's future, right? Everyone kind of wants an association or investment into an Elon Musk company. SpaceX is a private company. And although there is some liquidity in the trading of its shares on the secondaries market, and from time to time a tender offer where employees can sell shares, there isn't really much opportunity to have ownership of it. So there's a lot of interest here. But Starlink has been a game changer for people to access the internet around the world where they otherwise have not been able to because of the satellite and ground receiver-based technology.
Well, and a lot of people first heard about Starlink because of Russia's invasion of Ukraine, the Ukrainians using
Correct.
Starlink to defend themselves. There is a competitor from Jeff Bezos, right? I can't pronounce it, but it's like Project Kuiper?
Kuiper. Yeah, Kuiper, yeah.
Well, of course,
Yeah, and
because it's spelled K-U-I. Yeah.
Well, exactly so. And what they're trying to do is the same thing. Jeff Bezos has a rocket company. It's called Blue Origin. But in the first instance, they're relying on United Launch Alliance to put, and other carriers, sort of legacy rocket companies, to put Kuiper satellite constellations into space. They have a very small, like single-digit number of early prototypes. But it's this idea that, you can have
Whereas
global
Starlink has
coverage.
5,000, right, Ed?
Exactly. And not only does Starlink have 5,000 or in the thousands, that, these are satellites which go in low Earth orbit, and from time to time they have to be decommissioned or they get broken. But the other success of SpaceX is that it kind of feeds itself, right? You and I cover so many launches so regularly, and SpaceX has a rocket launch company where it's able to put its own constellation or maintain its own constellation with constant launching. And so let's fast forward just a little bit real quick. This Friday, we might see Starship attempt a second full launch. It's big, shiny, pointy rocket you may have seen. And the significance of that is not just that technology has the long-term goal of getting humans to Mars. I can hear Paul's eyes rolling and him creasing. But actually, if they can get Starship to be successful, it's the most powerful rocket ever designed and made, then they can even ramp up Starlink even further and take that 5,000 constellation to 10,000, 15,000, 30,000. And actually at Bloomberg Intelligence, they've crunched the numbers on that, and it basically helps you dominate connectivity worldwide.
So to date, Ed, has Elon been funding SpaceX just out of his own pocket?
Well, I love that story. You guys have been at Bloomberg a long time, right, on the news side, and we historically have not covered private companies as closely as we cover public companies for obvious reasons. But the cap table of SpaceX is fascinating. You have names like Fidelity and Sequoia on there. You have high net worth individuals. You have Elon Musk and Gwynne Shotwell, who Elon Musk being the CEO, Gwynne Shotwell being the president and COO of that company. There have been tender offers. Again, that's where staff can sell their stock units that they receive as compensation to buyers on the secondary market for simply liquidity. But when that opportunity comes about, sort of traditional asset or investment managers, high net worth individuals, even retail investors clamor to get a piece of that. Yeah. Partly because of what we've reported, there might be a Starlink IPO soon at the end of next year, but also you just want to own something because of Elon Musk's track record. So the cap table is really interesting.
Yeah, there's a great new podcast, Elon Inc. Have you been listening to
Correct.
it?
No, that's from Bloomberg Business Week.
Yeah, David Papadopoulos. I never realized that he has such a good voice for radio.
Yeah.
I mean, I've heard him, yammering at me in the newsroom, and it's not the same. But Elon Inc., what a cool podcast, which covers obviously all of the whole empire. So Starlink, SpaceX, Boring, Tesla, Twitter, which some people insist on calling X. And it's such a cool thing. So Starlink, maybe at the end of next year, but we won't be able to get a hold of the launch business of SpaceX as a public company.
My understanding and the understanding of my colleagues who reported the stories is that if Starlink spins off into a public company, SpaceX, the remainder, which is largely the launch business, remains a private company. And the transaction based on past precedent is, every SpaceX shareholder of note or record would receive an equivalent volume of Starlink shares. Obviously, their value would be changed relative to whatever they held the private SpaceX stock at. So that will be interesting. And just on that, there's only so much money you can make sending things into orbit, right? The per launch margin is much lower than a data-based business. So Musk has said in the past that it would cap out at like $3 billion of sales a year. Actually, I'd heard that this year it's more like $4 billion, $4.5 billion, but it has a limit.
I know that because I read Ed Ludlow's reporting.
Do you? Look at you.
And I watch and listen to him on Bloomberg Radio and Television.
SpaceX weighs spinning off Starlink via IPO as soon as 2024. But following Bloomberg's report, Musk called it, quote, false in a post on X, the social media platform he owns, without elaborating. Ed Ludlow, thanks so much. We appreciate it. Ed Ludlow, he's the host of Bloomberg Technology. He's wired in.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Jay Hatfield joins us. He's the CEO, founder, and portfolio manager of Infrastructure Capital Managers Advisors. He joins us here live in the studio. He doesn't phone it in, folks. Jay, there's no inflation out there. You've been saying this for a long time. Inflation's been coming down. CPI data this week, PPI data this week. Did that surprise you at all? Because it seems like it's a positive surprise for the market.
Thanks, Paul and Matt. Well, we've been pretty public. We put out a piece on October 31st, and we said this on national TV last week, that the CPI and PPI would print cool. But that's not because we speak to God or anything. It's just simply that we focus on oil prices and energy prices as a leading indicator. And what's not appreciated, even by our Federal Reserve, which is hard to believe, is there's a substantial bleed through of energy prices to core. And we did see that. If you think about it, there is no business in the United States that doesn't use energy, but some use a gigantic amount of energy. So food is 40% energy, airline fares. So you get both an immediate bleed through, particularly in airline fares, eventually to food. And so that's one reason we've been bullish and thought the rates were too high at 5%. We thought they'd come down to kind of this range. They might stall out around here. But I would focus on energy. And then also the other strange point about this report is we kind of already know next month's report. So you don't have to...
In terms of CPI, you mean?
Yes, because what happened, which is pretty unusual, is that it was sort of like a bell went off the first day of October, and gasoline ratably dropped 10% during the month.
Yep.
So guess what? Only 5% was reflected in October, and there's going to be another 5% next month, and we're already halfway through the month, so it's unlikely to skyrocket. And also retail has lagged.
And just to that point, the daily national average gasoline price, regular unleaded, $3.34 today. It was $3.90 just back in mid-September.
Right. And we kind of know that that will decline for the rest of the month, because what happens is when wholesale comes down, there's a lag because you have inventory in the channel.
Yep.
So the chances, we kind of already know that we're going to have a cool CPI and PPI, both headline and core, for next month as well. So that's pretty bullish.
But now the core is what really counts, right? Because the energy prices really are transitory. The swings that we've seen just in the last year show you that. I quote your CPI-R index quite often, which is your own proprietary index. I find it on the infracapfunds.com page. And it's come down substantially compared to what the BLS gives us. Their core CPI right now is 4.13, right? And yours is... Oh, sorry, this is September, but it was 4.13 and yours was 1.3% after having come down below 1.
Right.
Yours was also higher than the highest core CPI back in June of last year. So it was higher. It's been much lower. Do you think it's possible that inflation resurges again?
Well, I wouldn't totally ignore the energy price dynamic, because that does feed through to the whole economy.
It has knock-on effects.
And keep in mind that we have an 80% cost advantage on natural gas too, because we're the Saudi Arabia of natural gas, and that affects electricity. So it is a long-term bull factor that we have low energy prices in the U.S. But with regard to the
potential for a resurgence in inflation.
So the answer is there's a little bit of a sign of that, and that's why it's better to look at Case-Shiller than the ridiculous stuff that the BLS puts out. So we actually have had, like, for instance, we just we didn't update our website yet, but we just put out a release yesterday that now our measure is up to 2. So because Case-Shiller is actually ticking up. Now, I would still argue.
I see. So it was 1.3 in September. In the month before that, it was like 0.89. And now it's at 2. So your index is indeed coming back up.
Right. So, I mean, if the Fed was ever looked at it, of course, they might start to be worried, but they're worried about what it was like a year and a half ago. So, but I would still say that the chances of rates skyrocketing with the Fed having short-term rates above 5 and mortgage rates almost at 8% is pretty low. It's not impossible, but it's pretty low. So we're not really concerned about that. We think it's kind of just normalizing. And also rents do matter. And there are a lot of apartments coming online in the next year. So the chances of a big resurgence in housing costs are pretty low. And then it's not really going to affect Fed policy because it would take them 18 months to figure out that it was actually happening.
So what are we doing here? I know you're still bullish on bonds here. So how are you guys kind of positioning yourselves these days?
Well, you know, we sort of are the self-proclaimed preferred stock kings.
Okay.
So we love, it is self-proclaimed, by the way, but we love preferred stocks. If you really look at it, particularly funds like ours, have actually outperformed like almost all other fixed income. So they have higher coupons, which means they have lower duration. You can look all this up in the terminal because duration is kind of hard to calculate. And what also happens with preferreds, a lot of retail investors sell them in downturns. So you can buy them well below par. And then the final thing is very unusual about the asset class. It's has a lot of fixed to floating. So our fund's about over 50% fixed to floating. And why that's important is that all these rates were set when Fed funds was at 2, they're bumping up to 5. So you're getting a 3% bump in a good portion of it. So we would urge investors to take a look at that. You can buy funds like ours, or you can do it directly. If you do it directly, you might want to get a terminal, though, because it's pretty complicated. You have to look up all the...
Yes, you should get a terminal.
Yeah.
Thanks for the pitch.
You can use the infracapfunds.com website for your inflation data, everything else on the Bloomberg terminal. Jay, we called you in here because the EU says that the euro area and its biggest economies are going to avoid a recession. You've been bearish on the European Union. What do you think is going to happen in that economy?
Well, we prefer real-time data as opposed to like econometric models. And so if you follow the recent data, even this morning on ECO, Eurozone, there was a terrible industrial production report that came out. I think it's down over 1%. But also you can access on the web the equivalent of the Atlanta GDP now. And so the Eurozone GDP now is tracking at a negative 1.2% annualized rate. I mean, the quarter's early on, to be fair, but that was also, presaging that we would have a recession last quarter too. And then all that's just the individual data is terrible. And there's no bull case because we had 2 rate increases last quarter. And keep in mind that 45% of mortgages are floating rate in Europe. So those increases haven't even yet shown up in retail sales. So and they, of course, don't have the energy cost advantage. They don't have any of the advantage of the U.S. They don't have a shortage of housing. They don't have counter-cyclical infrastructure spending. Their natural gas prices are 5 times ours. Wow. So we have a big, so they're really kind of a disaster, and our data shows. And I wouldn't be too focused on the your official forecast because they update them they're a little bit like the BLS. They update it every 6 months. So you'd be the last.
Industrial production in the Eurozone fell 1.1%. That was worse than expected. That data just out about 10 hours ago. And industrial production year over year was down 6.9%.
So it's just awful. It's just flat out
very
awful.
bad.
Yeah. All right, Jay, thanks so much for coming in again. Really appreciate it. Taking a walk across town. Jay Hatfield, he's the CEO. He is the founder, and he's the portfolio manager of Infrastructure Capital Advisors. They like preferred stocks. You don't hear that too often. That's pretty cool.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Check out our next guest right away, Chris Whalen. He's the chairman of Whalen Global Advisors. Chris, thanks so much for joining us via Zoom here. I mean, you look at this market over the past couple of days, It's basically telling you inflation is whipped. We've seen peak rates. What do you take away from some of the data we've received over the past couple of days?
Well, the fact that we're looking at data of this maturity tells you something. We should take a somewhat more nuanced approach, I think, to rates because the volatility has been so enormous one way and another. And also the quality of, forward rates, for example, the 30 and 60-day rates in the mortgage market, which is the foundation of the treasury market, by the way, has been all over the place. So today I would tell you the belly of the curve, that contract closest to par, is still a 6.5 to a 7. So that means to make money, you have to be writing 7.75% mortgages, if not 8s. You know what I mean? So things have yet to settle down, even though we rallied a point in yield over the last, week? So, the aspirational aspects of this, I think, cannot be dismissed.
So you've got to be writing higher rate mortgages. And how is the mortgage outlook right now, Chris? Because the housing market seems to have ground to a halt, at least in terms of existing homes, which means probably very few people are going out and getting those mortgages.
Well, it's largely a cash buyer's market today. You're seeing compression above the median, which is about $450,000, by the way. The average is $330,000, I think, if you look at the mortgage bankers' data. So, the way I would say it is we were dragging the yield curve up. So it's been very hard for lenders to make any premium when they sell their loans into the bond market. And that's changed a bit. You may also see some lenders have a good quarter because of the rate rally we've seen. We had a pretty decent quarter in the second quarter for a lot of publicly traded lenders as well. So when the sun shines, they make hay. And I think, we'll just have to see, because the next auction, we could be having a tough time. And you could see rates back up again. So for mortgage lenders, you lost a lot of money on your hedge, but you're making a lot of money on the assets that you have.
By the way, the last auction, or the auction last week that kicked things off before Powell came out and confirmed what looked like a more hawkish bias. Was that actually affected by the ICBC hack? That's what the early reports from the FT said, but I just don't get it.
I don't know if there's a connection there. I do know that some very smart people, whom I have a lot of respect for, that run banks, are extremely concerned about that hack, even though it was small, because it implies that they're not sufficiently vigilant in terms of operational risk. At the same time, as you saw, I worry that Secretary Yellen was essentially backed off and forced to downsize the long bond auction because the dealers told her it wasn't going to get done. And you still had a spike in rates, Matt. So that worries me. It reminds me of when I was a little younger and we used to worry about treasury auctions. We haven't had that worry in 20 years.
Yeah, but now it moves markets. We had a bad auction, and 3 minutes later you saw the tail and the S&P 500 sold off. It makes you think maybe Yellen and whatever you call that Treasury Committee had a point when they decided not to sell 100-year debt at zero interest.
No, they should have done it. Come on. You're a fund manager. It doesn't matter if you work at the Treasury or not. You obviously should have done that trade. You should have funded infrastructure when that trade was available. We didn't do it. We just spent the money. So I think there's always second guessing. But today, I think Treasury is facing a lot of tactical challenges. And that's just the reality. And it will affect stocks, no question. The banks are down. Are they cheap? I don't know. It depends which bank, right?
Exactly. Hey, Chris, what we're not hearing about too much recently is the commercial real estate exposure for a lot of these banks. What's the latest on that?
Oh, it continues. You're not going to see most of it because it's private. This occurs behind closed doors with lawyers, and these are professionals on both sides. But if you look at some of the specialty press, like The Real Deal, which I love, by the way, there's a lot of stuff going on. There are assets that are being marked down. You're going to see a wholesale markdown of rent-stabilized assets in New York after the FDIC is done selling the Signature Bank properties, the rent-controlled properties that frankly are unsaleable, but they're going to try. My fear, and I think a lot of people's fear, is that they're going to hit a very low bid to get out, because ultimately the receivership of the FDIC is not a long-term investor. They're there to turn the assets into cash and try and minimize loss. That's their mandate. So, they have retained a majority stake in a lot of these buildings, Matt, because nobody wants them, given the political environment in New York.
Well, I have been reading
2019 rent control legislation has to be repealed, or we're going to destroy rental assets in New York as an asset class, because the banks can't fund them. They can't.
I mean, and residential doesn't even look nearly as bad as office, right? Because you mentioned the Real Deal, and I've been reading that website lately, realdeal.com, because we had this guy in, Yigal Namdar, who I think I think it's fair to call him a billionaire. Certainly when we last vetted his holdings, he was in 2021. It's like he and a couple of other guys with whom he works are the only people buying office in New York. No one else is trying to catch these falling knives.
Well, you have to have a view of the real estate value that is, to say, the land, and then the asset that's on it, and whether or not it can be utilized in what's going to be a different business case. I think a lot of people see New York going to a largely residential configuration, but I don't think you can pay for this city unless you have business as a partner, and that's what's got to change. We have got to stop attacking the business community, because they'll leave. And they did, but they went down south and built a lot of new buildings, and now we're overbuilt in Texas. We're overbuilt in some other markets. No, seriously, the herd left. They were told to leave, by the Democrats of New York, and they did, because the capital is mobile. Miami, Matt, you spent time down there. Insane. And then look at around the region. Look at the Canal Zone. Look at some other cities in the region. They're all getting buried in investment in commercial real estate, residential real estate.
I hope what happens in Miami stays in Miami, because I have spent some time down there.
Look at the
but
Canal
I don't want to talk
Zone.
about it publicly.
Look at the Canal Zone in Panama. It looks just like Miami. Big empty buildings.
Yes. Okay. Hey, you write a lot for the Institutional Risk Analyst.
Yes.
And one of your posts recently, Big What, Rising Debt Service and Falling Liquidity, you're writing about, the mortgage and the lending business, but I'm thinking about the U.S. And I wonder what is your take on the fact that we're going to have $900 billion in interest rate servicing costs next year. Does that change? Do you see rates coming down and that gets better? Or is that something that Washington can fix somehow?
Well, Washington has got to start reducing the deficit. I know that's not fashionable, but from a tactical perspective, just looking at the cash balances that Treasury has to maintain in order to move payments around, it's a problem. The Fed collateralizes all of that, Matthew. They go out and buy bonds to collateralize the Treasury general account, and that's a market-moving event too. So the size of the Treasury is becoming an issue in the markets. We're seeing crowding out come back as a novel concept, right, in economic thinking, because it's so obvious. Luckily, housing is down. Imagine if we were trying to finance $4 or $5 trillion this year in housing. At the same time, Treasury was out raising all this money. We're going to do $1.5 trillion this year. Nothing.
All right, so, Chris, I got to wrap you up there, unfortunately, for time. But Chris Whalen, love to get your insight on the industry. He is the institutional risk analyst and also chairman of Whalen Global Advisors.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The stock market likes biotech. The stock market likes AI. So how about an AI-inspired biotech company? And how about an AI-inspired biotech company that has a new shareholder disclosed just today? That would be Cathie Wood's ARK funds. You put it all together, Matt, stock's up 16%. We're talking about Recursion Pharmaceuticals. The symbol is RXRX. And we just happen to have Tina Marriott Larson, the president and COO of Recursion Pharmaceuticals, with us. So that's a coincidence, a serendipity, I guess. I don't know what you want to call it.
That's a face-ripping rally.
Face-ripping rally. Tina, what have you learned about your new shareholder today?
Well, thank you. I don't usually use the term face ripping, but I appreciate the introduction. Great to be here, Paul and Matt. And yeah, like all of our shareholders, it's great to have these strategic, long-term thinking shareholders that really share our vision for the future of where the biotech industry going, the tech industry is going, and really the opportunity to use technology to create the next generation of biopharmaceutical company.
So what kind of strides are you making? Because, it's great to have a very famous and, followed shareholder. It's great to see your stock take off in double-digit gains. But at the end of the day, I imagine your ultimate goal is, I guess, curing cancer, right? I see that you do a ton of oncology work in partnership with some of the biggest names in the business. So how is adding AI to the mix getting you closer to that goal?
Yeah, absolutely. Cancer is a big focus for us. And as you mentioned, our partnerships, we recently announced an expansion of our long-term partnership with Bayer. We're going to be working on up to 7 new oncology programs with them, applying the latest and greatest version of our technology platform. In October, we announced the first milestone and option from our partnership with Roche and Genentech, which was in oncology as well. And so we're definitely focused on oncology as well as other areas like neuroscience, once again, with our partners at Genentech Roche. So we're really seeing great progress in applying these technology platforms, this emerging field of tech bio, to really improve the outcomes in the way that we do R&D research to discover new.
Well, what are the most important breakthroughs that you've made, or what are some breakthroughs that you're hoping to make? This is what these are the moonshots that Wall Street bets on. What's yours?
Yeah, absolutely. And so we are industrializing drug discovery. So if you think about the way that many small biotech companies, maybe they're looking for 1 or 2 drugs in very targeted areas of biology or very specific areas, say of cancer, we're actually looking across human biology. Our mission is decoding human biology to radically improve lives. And we're using the technology to do that. And so you see that we have bets in neuroscience, we have bets in oncology, we have our own internal pipeline of molecules in things like rare disease and oncology. And we're actually going to see our first readouts. We're anticipating those next year for our internally developed drugs. But ultimately, the goal is to scale and industrialize so that, in the same way that other industries have been disrupted by technology, so that we can bring better medicines to patients faster and more cost effectively.
So specifically for your company, Recursion Pharmaceuticals, what do you guys do? What is your technology? How do you bring AI or just technology broadly defined to the pharmaceutical and the biotech space?
Yeah, it really starts with data sets. And so I like to use the Google Maps analogy quite a bit. I'm old enough to have navigated around, say, Washington, D.C. using a Rand McNally atlas, and that was pretty hard. At night after you'd land there on a plane. And so, and what Google Maps revolutionized that part of our lives by both creating great data sets of the Earth, of cities, of maps, and also creating the algorithms and computational technology in order to analyze those large data sets. So the analogy to what Recursion is doing is that we are creating data sets. We have 20 petabytes of data, 25 petabytes of data, actually, it grows so fast, that we have actually grown in-house here in our laboratories. To the right of me, there's a whole bunch of robots doing science right now, creating these in-house data sets, modeling the human body right here in the laboratory. And then we add data sets, like we recently announced that we have developed a partnership with Tempus, and they have real world data. So we have preferred access now to over 20 petabytes of data from 100,000 actual cancer patients and the outcomes that those patients have had out in the real world. So we're constructing these very large data sets and then using tools like machine learning and artificial intelligence in order to use that model of biology to find new medicines for diseases that today are underserved or unserved and have been intractable previously for the industry to find cures.
It's hard for a normal person to know what a petabyte is. Even if you,
I think it's a lot of numbers.
Even if you Google it, apparently it's 1,000 terabytes.
What's a terabyte?
I don't
yeah,
know.
So I think one of the fun analogies we have used here is that if every high definition film ever made is a few petabytes, and so we have far more data than if you streamed every movie ever made in high definition. So these are very, very large.
Nice. Paul is actually on a mission to do that right now.
Exactly.
Streaming every single HD movie on the New Jersey Transit.
Yep. So Tina, I mean,
you need like 1,000 years, Paul, but good luck.
I know. I have a long commute. So Tina, talk to us about, is the biotech industry, is it open to this type of technology coming into what has been historically, just very, I don't know, sciencey stuff?
Yeah, I think the openness is growing. My background, I spent decades ago at the revolution of biotechnology. I was at the Genentech, the company that led the biotech revolution of our industry when we hit an R&D. They're one of our biggest partners now, and now being at this leading of the tech bio revolution. And even a few years ago, when I joined our co-founder and CEO, Chris Gibson, here at Recursion, there was still a lot of skepticism about how AI and technology was going to change things. I think now that artificial intelligence has become so much more broadly impacting our lives, across industries, now that kind of skepticism really has switched to curiosity. And I think now you see large pharmaceutical companies really trying to craft their AI strategies, getting really curious about how this is going to revolutionize the companies. And so I think we've kind of transited most of that skepticism as to if technology and computational technology revolutionizes the industry. And now the question is how.
Hey, Tina, really fascinating discussion. I really appreciate it. Tina Marriott Larson, President and COO of Recursion Pharmaceuticals. Ticker symbol is RXRX. It's a NASDAQ traded stock, and it was just disclosed today that Cathie Wood's ARK funds have acquired a stake in this company.
But our producer, Eric Molo, booked Tina for the show before we knew that. And in fact, he booked Chris, the founder, back in July.
Wow.
So he essentially beat Cathie Wood to it.
I know. Now, did he buy any stock, did Mr. Molo? I'm guessing the fact that he's still back there behind the other side of the glass, that the answer is no. But we appreciate the booking nevertheless.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.